In this video we're using my favourite indicator, the multi-time framed moving average, and the Heikin Ashi indicator set on the chart. This is an amazing strategy and I think you're going to love it. Okay, so how does this work? Well, first of all, we have our multi-time framed moving average. The moving average time frame is set to 1 day, with the moving average period at 20, a simple moving average method, and it's set to close. This is now put on the 1 hour chart, and for today's illustration we're using the Euro USD. As for the Heikin Ashi, it's literally the inputs are simply the colours. There is nothing else to change on here, so we're going to leave that as standard. And the principles are very similar to some of the other strategies that I've shown on my YouTube channel. So let me just outline them for you. Firstly, we set a stop loss at no more than 50 pips. That's the first point. The second point is that I usually run a 2-to-1 win to loss ratio. So if I'm risking 50 pips, I'm looking at making 100. If I'm risking 30 pips, I want to make 60. The third point is that once we hit a 1-to-1 ratio, we set our stop loss to break even and let it run to the 2-to-1 ratio, if that makes sense. So if we're risking 30 pips, once we've gone 30 pips in profit, we set to break even, and then we look to make the next 30 pips and take profit. So sometimes that's going to be to our benefit. Other times, you know, if we're looking at risking 30 pips, we're going to be 50 pips in profit, but then come back to hit our break even. That's just the way it goes sometimes, but you'll see in your trading back testing that often this can save you lots of lost pips. And when I say to break even, what I mean is that we've set our break even to maybe, you know, a few pips in profit. So even if it does hit our break even, we've still made a small amount of profit nevertheless. So look, I'm going to go back to, I don't know, the beginning of March. This is random data. It's a live chart, random data. I've not even tested this on this data, but this is the way the strategy works. So you've got your moving average here, which is following the daily. So when price is below the daily moving average on the 1 hour chart, you're only looking to sell, and when price is above the daily moving average on the 1 hour chart, you're only looking to buy. Now this strategy is not a let's wait for an arrow and buy, and let's wait for another arrow and sell. This strategy means that you have to be aware of the chart and use your intuition and any experience that you might have. So this is not necessarily a strategy for beginners. But of course you can let me know in the comments below when you watch this video. So here we go. Here's the first example. Price is below the moving average. What we're looking for, and this is a strategy actually that another YouTuber has used with the Heikin Ashi, but I've just adapted it to use the moving average so that we know where the trend is going. So what we're looking for is the Heikin Ashi. We're looking at, here is the candle, the lowest point here, and you see the next candle, its wick is lower than this wick. So what you would do is you would draw a line across there, and you're waiting for it to break, which it does just here. Now this candle here hasn't broken, because although the wick has come below your line, the body of the candle hasn't, but this one has. So you would literally, if I insert an arrow, you would literally be on this candle here. You see where it's broken below the line. So the wick here is below this wick. This one here, this wick, sorry, is below this one. So this one here, this wick is above. So this is the one we're going for, and it breaks below. So you would go here and you would set your stop loss. If you wouldn't go right up here because it's 80 pips. That's too far. Your risk tolerance is too much up there. So the next kind of high is really just above this daily moving average. You could set it to 300, which is literally just above it, or you could go to kind of 350, which you'd probably just be stopped out. If you went to 40 pips, you'd be safe. You'd be looking for 80 pips if you set your stop loss at 40, which you wouldn't get, not quite, you'd get 74 pips. But there's a good chance you'd probably set it to 35 pips and you'd probably just be tapped out. So that would be a losing trade, unfortunately. But that doesn't matter, because look, here this candle is here, and the next one, the wick is lower. So this is not a straightforward strategy, but if you really listen to this video and take in what I'm saying, then you'll understand. If you're just going to watch about 1 minute of this video, you're not going to understand this strategy and you'll just switch off anyway. So that's fine as well. But there's another rule here that I have. Now here is the next kind of high. If price just breaks that high, then you're not interested. In fact, in this case, it would be above the moving average anyway. But look, this candle here has not broken up here and above it, this candle. So this trade here, this line is still valid. And eventually, it's this candle here that breaks and closes below the line. You would set your stop loss at 450 and you'd be looking at 45 pips, and you'd be looking at 90 pips take profit. So remember that you're setting at a 45 pip stop loss. I mean, actually it might be 50 pip stop loss, which would be your maximum, and you'd be looking at 100 pips profit. It comes all the way down, it gets to the 1-to-1 point here, you're 50 pips in profit, and at this point you set to break even. And this is where doing this is actually quite a good practice to do. So you've set it to break even, it hasn't hit 100 pips, it's gone down to 63, and it comes up and closes you out. As it happens, it actually comes down and you would have made it, but it doesn't matter, because look what we're going to do now. We're looking for 2 red candles, okay, 2. So one with a lower wick and one with a wick above, and we want them ideally to be consecutive red candles. There's no consecutive red candles here, unfortunately. So this wick is lower than this wick, so it doesn't count. This wick is lower than this wick, so it doesn't count. Then you come up to here, and if we just zoom in a little bit, you'll see that this wick is higher than this one. So we're going to draw a line here. We're going to draw a line right across, and what you're looking for is a break below and close, which is this candle here, and you'll be setting your stop loss at about you could set at your maximum of 500 up here. More than likely you'd probably set it at not 50 pips, but probably 35. So you're looking at you want a 70 pip take profit. Easy, absolutely easy. So at the moment you've had one loss of 35, you've had a break even, and now you've had a nice big win of 70. So you're actually 35 pips in profit at this point. So here you've taken your profit here. Now what you can do, if you really wanted to, is you could go in for another trade. You could say, well, hang on, look, there's a wick here that is higher than this wick. So if you wanted to, you could draw your line across here, and again you're waiting for a break and close, which you kind of just about get here. But if you wasn't quite happy with that, you'd definitely be entering here. You'd set your stop loss at, well, not right up here, that's 100 pips. Maybe, if your risk tolerance isn't too much, maybe 300, maybe 30 pips, just around here, 35 pips, and you'd be looking at between 60 to 70 pips, and of course you would easily make it down here. Sometimes I like to see a pullback before I start entering again. Of course, it's a nice trend in this instance, and the next pullback would probably be here. So what you'd be looking for is drawing a line there, because you've got a little pullback, you've got wicks that are higher than this one, and then you're waiting for a break and close, which is just here. You've got a nice area to set your stop loss. You see here, there wasn't much of an area. It's hard to tell, where am I going to, there's no pullback to put your stop loss above. So you might not take this trade. But here you've got a nice little pullback. And if you entered here on the break and close below your line, you've got a pullback of 35 pips, and you're looking for a 70 profit, which, oh my word, you don't quite get, but you would definitely be setting to break even anyway. So you see in this strategy that there's quite a lot of opportunities to enter. Okay, the reason you're selling is because price is simply below the 1 day multi-time frame moving average. It's very, very simple strategy, and I encourage traders to keep their strategy simple. Okay, there's no need to complicate it with hundreds of indicators. If you're going to use an indicator or two indicators, then pick one that, again, is simple, one that you understand very clearly, and maybe even one that you've developed. So a bit like this. This is a simple Heikin Ashi, but where do you enter and where do you exit? Well, I've just explained several trades here where you enter and exit and the reasons why. So I want to explain another thing as well, and I want to find a trade that explains what I want to show you. So let me have a look. Okay, so here's a good example. You've seen this trade here, and you're thinking, great, the wick here is higher than this one, so if price breaks and closes below, I'm going to enter a trade. Now, the reason I'm highlighting this is because what you could do is extend the line right across, and you would enter a trade here, and as it happens, it would be a really good trade. But that's not what I want to show you. Your stop loss would be here, but price didn't close at this point below your line, and what price did is it went above where your stop loss would have been, in which case the trade is not valid. I'm not interested. I'm going to look for another entry somewhere else. Okay, and the reason why you don't have to worry about this is I'm about to show you why. Because look up here, you're going to have an even better entry up here. Now here's 4 consecutive reds in a row. You're going to draw your line across because the wicks are higher than this one, and then price closes below here, and you're going to set your stop loss at 30 pips, or yeah, about 30 pips. You're going to look for 60 pips. Absolutely easy. What a perfect trade that is. That is an awesome trade. Yeah. So if you had have extended this line across, don't get me wrong, it would have still worked. Yeah. But you've caught the trade 60 pips higher. Yeah. So I like to say, look, this is where I would have put my stop loss. Price has gone above my stop loss, so this is not a valid trade, and I'm not interested about extending the line across because price has rallied above where I would have put my stop loss. So I'm not comfortable. But because this strategy gives you so many opportunities to enter the market, be patient. Don't worry. Don't chase the market. Let the market come to you. Okay? Your stop loss is still reasonable. It's only 30 pips. You're not going to lose masses of money. And you're going to get an absolute professional, perfect entrance right up here. And of course, it goes for many, many pips until you get a little pullback here, and you might even decide you want to re-enter by putting your line down here and waiting for price to close below it, which it does. So, and of course you get more pips. This is a fantastic strategy, but you need to practice and you need to understand. So it could be that you need to watch this video a couple of times to understand the strategy and what I'm trying to say. So if you have any questions, write them in the comments below. I do answer every single question that people post. If you like the video, give it a thumbs up. If you haven't subscribed, please subscribe and hit the notification button, because I'm going to focus on this strategy. I'm going to do more videos on this one because I think this is something that, well, I personally use it myself, and it's actually a very simple strategy once you get the hang of it. So so as I say, give the video a thumbs up if you like it. Both of these indicators are on my website, and you can find it in the link in the description below. So visit my website, you can get these indicators and you can practice this strategy for yourself. I hope you've enjoyed the video.